Another tumultuous week on the markets, with the election cliffhanger the initial focus, although as the week wore on, there was more comfort that Australia may avoid a messy minority government, with a coalition creeping towards the 76-seat target for the lower house. The Senate, however, will take a number of weeks to clarify, and will inevitably have a strong flavour of independents and minor parties. But the Aussie dollar took all of this in its stride, and looking at its path over the last month, was more influenced by Brexit than anything else, including the RBA's no change to rates decision and even the Standard & Poor's negative outlook announcement on our AAA sovereign rating. So there are a number of question marks around the federal government, the AAA credit rating and news from overseas, but for the RBA, no change in July wasn't a surprise, whereas a cut in rates in August is favoured, with the implied probability tracking at 61%. An odds-on favourite, but nothing is a certainty as Brexit and the election reminds us. Beyond there, the market is favouring the cash rate staying at around 1.5%, although Capital Economics is calling for more cuts down to 1%, uncharted waters. Glenn Stevens only has 2 more RBA board meetings to chair before he hands over the chair to Philip Lowe. A parting cut does look likely. Back to Europe, and the Brexit aftermath has seen the pound sterling fall further as expected. But the Bank of England surprised the markets by slashing the capital requirements for UK banks. And, even more worryingly, we saw a number of UK property funds suspend their redemptions this week, an eerie parallel to mid-2007, when the first CDO hedge funds halted their redemptions. The difference here is the lack of a direct global impact, given investors in these funds are mainly UK locals. This news, however, combined with growing concerns on Italian banks and their non-performing loans, has seen global yields hit fresh record lows, including here in Australia. And finally, the latest Australian retail sales data showed only a marginal rise in retail sales, up 0.2% in May, with clothing the weakest area, apparently a function of the unusually mild May, which should be unwound considering the latest cold snaps in June and July. To avoid another rate cut, we will need to see a pickup in retail activity, a higher inflation print, or good news from the jobs market with the next readout on Thursday, or a combination of all three. I'll see you next week for the next market update from Bendigo Bank.